Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, August 30th, 2024. It's 12:16 p.m. Eastern Time as we head into the final 4 hours of the final trading day of the month. So what I'm going to do in this video is in roughly this order. I'll touch on the indexes real quick, the stock market, talk a little bit about NVIDIA due to the fact I think that's one of the, if not the most important stock right now in the entire market. Brief update on the semiconductor sector, Intel too, bearish the semis, NVIDIA short there, but bullish as Intel is both an indirect hedge or a pure play, however you want to look at it. Updates on some of the recent highlighted trade ideas, PayPal, AXP. I want to update again. I covered the financials yesterday. And then I'm going to go over, might even do this in the beginning of the video, go over a few charts that really speak volumes to me. Okay, so let me just start out by saying this is the current condition of the market. If you are frustrated lately, bull or bear, recognize any market condition for what it is. This is the S&P 500 ES futures, and I'm on that 15-minute chart I've been zooming down to. So since the middle of the month, for the last 2 weeks, we've gone exactly nowhere but sideways. And these are little micro levels. And when you're in a small trading range, that's what I'm going to get out to you. This is not anything for a long-term investor or swing or trend trader to really care much about, other than once, if and when we have a solid break above or below this trading range, that is likely to be the catalyst for the next tradable trend, 5-10% plus chances are. So that's what it looks like on the 15-minute chart. We got that little, I got out to you today before the market opened, or right after. We had this little uptrend line off the lows, breakdown, triggered a sell signal, took us right down to the first support/target, 5610, where we've been since. That was, probably an hour ago I got that out to you. These are 15-minute candles. So you've got 1, 2, 3, 4. Yep, so there it is. There's your hour of trading right on that level. Like I said, a reaction was likely. We hit that level. And the takeaway, too, is even if you're an NQ trader or whatever you're trading, you want to look at the S&P 500 as well. Because although I didn't have, as you can see here, I didn't have any support marked on NQ, the same the algos come in, the same traders that buy SPY, or those traders that buy SPY are proportionally buying the same top, actually not as much, but they do have the same top holdings. They're just at a lesser weighting. In other words, the indexes move together. So you want to open the door to the, a next wave of selling. First of all, you have to take out today's lows, which will take out that support in ES. That'll take you down here to NQ. NQ probably have a little reaction there. And then if that level goes and a comparable level on ES, then you come down here. Otherwise, that's that. So now we're in a trading range and we've been grinding around. And right now, the near-term trend in the what I consider the most important index, the NASDAQ 100, is still lower. But, we're going to have to take out this previous low to keep that going. And ideally, and you don't always get ideally, by the way, guys, these trends you can do this, pop up here and then still go down, but ideally you want to keep not taking out these prior reaction highs right there. So, it's Friday. Look, all I can tell you definitively is we have these breakdowns. The NASDAQ really isn't at support. The S&P 500 is, and that's it. So if the S&P can rally up here, great. I favor moving down. We had that sell signal today. I think this level will go, and we'll probably get down there. And then this is really what you want to watch next week, those levels there. I've stressed the importance of the euro-US dollar and told you that the correlation, it's not a one-to-one direct immutable correlation. This happens quite often that you have a turn in the currencies, then the markets get the memo later on. And it's pretty simple stuff. The reason why gold goes up when the dollar drops. Remember, the euro is just the dollar upside down. So when the euro is falling, the dollar's rallying. And when the dollar is rallying, here, we'll go to DX. So we'll talk dollars. I just like charting the euro. So here's the dollar futures, DX, US dollar index. And so it's simple stuff. When the dollar goes up, it takes fewer dollars to buy an ounce of gold, so the price of gold goes down. And then when the dollar drops, it takes more dollars to buy an ounce of gold, if you freeze supply and demand, so the price of gold goes up. And the same thing happens with U.S. stocks. You've got, where U.S. tends to be an egocentric nation. But remember, there's a lot of foreigners buying U.S. stocks. And when the dollar's falling, that's where they want to have their money. And stocks are going up. Stocks are going to be worth more per share. So you have that same net effect where a falling dollar is bullish for both stocks and generally speaking. There are periods where the disconnect happens, but generally speaking. So that's it. And you can see it in gold and silver today. Obviously, the dollar continued to rise off that divergent low. Gold has that pattern of putting in these higher highs right here recently. This is just my 2-hour chart. I also have it on a 60-minute chart. I've been showing that to you quite a bit. But there's a breakdown of the most recent wedge. And silver, remember silver, we highlighted back here, was the better of the two in my opinion on this. Only one you can make a decent case to buy. You had a divergent low at support, pretty good support too, 26,954, and we got a rally off there. It set up this rising wedge pattern, which was capped at that 3070 resistance level, and it broke down. And now with the dollar going up and the euro going down, you're seeing gold and silver coming under pressure right there. So overall, silver's still lagging gold. Gold, recently made a new high, and silver hasn't yet. But either way, that's it. And so the $1 million question is, how much more do they have to go? When I look at the chart, I would say the euro is probably going to come down before all is said and done to at least this level here, that 1097 target, and the U.S. dollar going up. And if that is the case, the dollar coming up to this level here, 103.086, or next targets here and then there, then this will most likely put pressure on the market. And what happens is, after the turn, when the market or gold is ignoring the reversal in the currencies, the longer that goes on, the more powerful the mean reversion, when the gold traders and the stock traders finally get the memo. So look, it hasn't happened yet. All I can tell you is, just like those 15-minute charts I gave you on the indexes, support is support until less broken, right? We hit ES support. We're trading on that support since we hit it earlier today. And we're in close proximity here with the euro also. You want to watch them both. Just like I watched the S&P 500, even if I'm only trading the NASDAQ 100, I want to see them both break support, because if one of them, let's say I get a sell signal on NQ, a breakdown of support, and right after that happens, the S&P 500 falls to a comparable support and the buyers step in there and buy, guess what happens? That breakdown in NQ fails. That's why I like to see both of them breaking comparable support levels to help solidify, firm up a sell signal or a buy signal in reverse if it's breaking resistance. Same thing with DX, the dollar futures, and the euro. Because the euro is simply the largest component by far, without a close second. It's almost all of the dollar index. It's 61.8%, or no, that's a fib number. It's here, I'll tell you what it is. USD, I think I have it written down here somewhere in my euro US dollar chart. On some board or another, I do. Anyway, oh, there it is. Yeah, euro is a 57.6% weighting in the U.S. dollar index, and the yen is the second largest at 13.6. And you can see the yen here recently, or USD. This is the forex pair, the dollar yen pair. Recently came down here. And it's at support. So what this says is dollar up against the yen. And again, that helps support the case for a rally in the dollar if it holds this support level and rallies, which, so far it's been holding that trend line. A break of that trend line now, that's going to change things there. And remember, it was this drop right here. Media chalked it up to just randomness. But this was a beautiful textbook bearish rising wedge with a divergent high. And when that broke, that was, again, with the media sign, the catalyst to the big drop we had in the markets recently as the bust of the yen carry trade, unwinding of the yen carry trade. And if you drop down, which I just did, to a 60-minute chart of the USD JPY pair, you've got the breakout right here recently. So these are old lines, but lines that I've had here for a while. But I'm going to pull that one down. Still, these are levels to go. So we can see the dollar rallying against the yen. That's also going to help DX, the U.S. dollar index, go up if that's the case. And again, that's likely to put pressure on gold and silver and pressure on equities. Okay, now I'm going to just loop over. Before I forget, I want to show you a few economic indicators or charts. Many of these I've shared, in recent months or years, and it helps to formulate my bigger picture, longer-term outlook, which I'll expand on those thoughts in 1 second. I want to differentiate because I just always seems to be, I don't know what to call it, confusion or obsession over long-term outlook of something, and then near term and how I'm going to be positioned. And I'll use an analogy here in a second if I remember to loop back to that. But it was the late great Sir John Templeton said the 4 most dangerous words in investing are "this time it's different." And so it's widely known one of the best indicators to look at how fairly or overvalued or undervalued the stock market is the Shiller P ratio. You can look it up. I'm not going to sit here and digress on that or debate or anything like that. But all I can tell you is our current level is at 36. Okay, just to put that in perspective, this is where it peaked before the crash, before the Great Recession, the crash in 1929, followed by the Great Depression. It was at elevated nosebleed levels then, as we all know, peaking around 33 or so. Fast forward to the dot-com bubble, which had set new records for insanity. Companies that had no earnings, no growth, no prospects of earnings. They just had the name. They were associated with the name .com. They put their name .com in the title somewhere, and everybody bought into the .com hype. Not too unlike the AI hype now. And look, .com was here to stay. The internet didn't go away, but there were, again, it was people just buying stocks without really caring or concerned about the fundamentals and valuations. And so you can zoom in here back before the market peaked. This is where the Shiller P ratio peaked right here. Here, I'll drop it down a little bit. Remember, the market peaked in November. It was the NASDAQ 100 that actually topped us. I pointed out many times. We got short that top on November. It was late November of 2021, and that's where the Shiller P ratio peaked right there at record high nosebleed levels. And again, we are at, you can see it here, we're at 36, not far off that level. That was followed by, I think it was a 38% drop in the NASDAQ 100 then. And again, it was mostly about the tech sector being overvalued, and that's what we have now. So you can see it there. So basically, there's only 3 times in the history of the financial market, so the U.S. stock market, where we've seen levels this high or higher, and that was just before the right before the peak in 2021 and at the dot-com bubble. So that's one chart again. So my whole theme is, this time it's going to be different because God knows they're out there and they march them out every day, and I understand that is that's my background, financial Wall Street, working for investment firms as a financial advisor, stockbroker, and you had to believe that the markets are always going to go up, that this time it's going to be different. Overvaluate doesn't matter. Just keep buying stocks. They're always going to go up. And again, guys, I'm going to talk on that in a second about my long-term outlook, and then also how that it will differ at any point in time with my positioning. The other one, which again with the 0 exceptions, I'm trying to make that bubble go away here. Let's see. Can't make that thing go away. This is a yield curve. I'm going to zoom down. I'm a little zoomed out here. Let's get it down a little smaller. There we go. I think this will work for you. Okay, so you've got the spread right here. This is the 10 and 2-year Treasury bond spread. And as I've mentioned many times over, and I even told you watching Powell at the last press conference after the last FOMC decision, he kind of dismissed how the yield curve doesn't work anymore, how that we have finally the first false signal. No, all he has to do is look and study, and most people that have used this indicator know it's not the inversion. And guys, I know I've covered this 100 times, but there's always new subscribers coming to the site, which, by the way, a couple of you, I got the emails and somebody posted something in the comment section. There was a technical glitch with the site over the last week or so where new subscribers weren't getting access. I went in and fixed those. I'm going to look back, make sure we've got everybody. You should have access. If you're listening to my voice, hopefully you got this video. I'll mark this one, yeah, anyways, I took care of that, but this video will be subscriber content only, so I'll reach out. I'll keep checking the support form. Anywho, this is the inversion. There's the uninversion. There's your recession, gray areas. You might not see it in the video. There's the inversion. There's the uninversion. There's the recession. These are all recessions. I'm circling the gray lines here. Again, you can get this chart, pull a yield curve chart. This one's from Guru Focus. The COVID recession, and in each and every instance, the inversion came first, and then it can take up to a few years later, sometimes a year, 2, 3, but it's the uninversion after the uninversion, invariably, with zero exceptions. Let me repeat that. Invariably, without any exceptions, a yield curve has incorrectly predicted the past 7 recessions. We inverted here. We have not uninverted yet. But you can see from this, as soon as we get that, most likely as soon as we get that locked in rate cut next month, this will most likely uninvert. And then that tells me the recession is imminent. Again, you want to think this time is different? That's your prerogative. And more importantly, we got to be careful in positioning, because an imminent recession does equate with an imminent bear market. However, imminent is relative. That term is relative to the time frame. This is a chart. It is not an exact timing indicator. That helps hone down the timing, but it doesn't give you the exact day, week, month, etc. that the market's going to peak. Now, I've already made a case that I think the market's top. That case was made before we hit the top, gave you a range. I'm going off that for the reasons I stated in recent videos and over the last couple months, unless proven otherwise. This is the 1 to 10. So the 1 to 10 spread, that means the 10-year Treasury versus the 1-year has a little bit more to go. So you want to help solidify it when both of these uninvert, meaning they go back over to a normal yield curve. Okay, this is from Lending Tree. You can get this from they even cite this from the New York Fed Consumer Credit Panel and Equifax, but this article, guys, come on now. The evidence. Again, I'm not looking for a run-of-the-mill bear market. I think what we had in 2020, late 2021, early 2022 into October was just a correction. It'll go down. It was a 36 or something % drop, I believe, in the S&P 500, or it was a 38 in the NASDAQ, maybe a little less in the S&P. By all the conventional metrics, a bear market. But I think initial shot across the bow. See what happens. And I've shared this many times. I've had my VIX, my VIX recession indicator, or bear market indicators, put to call ratios, sentiment. I have all these indicators that have been very reliable of hitting certain thresholds when a bear market's over or a bull market correction. And as I said, in October of 2022, when the market bottomed, we weren't even close. And you can see here, this is back in 2008. I think you can see it down here. I'm going to read it out for you. This is 2007 fourth quarter. For those of you that might not remember, it was November of 2007 when the S&P 500 and the NASDAQ both topped. So that's somewhere here, Q4 right there. And this is outstanding credit card balances from 1999 to present. And you can see that huge surge. A lot of people called the 07, some people referred to it as the housing crisis, but most commonly and most accurately referred to the debt bubble. It was a bubble of all kinds of debt, including but not limited to housing debt. And you can see, and we popped and we had a healthy recession that cleared out the excesses. Then consumers started getting punch drunk on free credit and easy money, low rates, again, leading up to this point right here when COVID hit. And COVID, popped that bubble again. We've gone parabolic. Look at the advance. Look at the slope of the line here. Look at the slope of the line here. And this is a near parabolic move, much steeper slope, right? And to levels that's just insane. Now, credit should be higher, relatively speaking, because of inflation. Remember, we've had what they say, official about 20% inflation since COVID, and so therefore the number should be up by 20%, but it's up more than that. You can see here, and it's just been insane. This near vertical trajectory in outstanding credit card balances. So you say, well, we know that's in part fueled the economy because that's just people spending money on stuff, and and they spend money on stuff, and companies are the beneficiary. But now let's look at this chart. Well, here's another one before. This is from the St. Louis Federal Reserve. Consumer loans, credit cards, and other revolving plans, all commercial banks. And again, you can see there's the 2007-8 recession, the Great Recession in '08. A lot of stimulus injected in the economy, a lot of people taking debt. There's COVID, knocked it down, and we've surged again. But here, let me show you one more I have here. This one. Okay, so you might say, well, Randy, that's fine. We're debt's good. Debt's gonna people taking out on their credit card. That means they're buying more stuff. This chart tells you right here. This is recent. Shares of balance transitioned into delinquency. So this purple line, you have auto loans surging up to 8% delinquency rate. Credit cards 9.1. Okay, guys, this is just like some of these other charts that I showed you. Once you have the hook, the turn, the trend is in. This was 2005, right? And I told you a minute ago, the stock market kept rocking and rolling until November of 2007. That's when the bear market started. Worst bear market, one of the worst in history. Both the S&P 500 and the NASDAQ fell over 55% over the next year and a half or so. And so what you can see is you first started ticking up, and it didn't matter back then because this time it's different, quote unquote, with my little air quote fingers right now. This time it's different. It doesn't matter because blah, blah, blah. Fill in the blanks. And then you can see there, auto loans started, or the credit card debt started going, delinquency rate started going up. And once that trend turns, that's it. And what this means is, and I did a video on the financial on the banks yesterday, that's the next where my crosshairs are. I'm already bearish and short the semis and the NASDAQ 100, and I think the next shoe to drop, and that'll kind of put the nail in the coffin in this whole, this is a healthy market because we're seeing, broad-based participation now. The S&Ps that are near new highs, and so this is just a rotation out of big tech. No, this unless we do this somehow, and hey, anything's possible, but you can see this huge surge up, and then you can see the trajectory here. And we look to be right now at about that point from off the lows where we were right about here, and that's end of 2007 when the stock market peaked, and then delinquency rates continued to surge, and the banks failed. The U.S. government had to bail them out, or the banking system would have collapsed, mostly, especially the big banks. So anyway, you can read it. And there's a lot of this stuff out there that shows you the same story. And the last two I'll leave with is this one, national unemployment rate. Again, I've covered this many times in the past. Invariably, again, with zero exceptions, you see, unemployment falls to record lows. The pundits come out on Bubble TV, the cheerleading squad, and cheer it, and why we're not going to have a recession. We can't have a recession because the employment job market's so strong. And when the job market's strong, the consumer's strong. Doesn't matter how much credit card debt they have, they've got jobs. Well, as I've said, and many times over, there's little zigs and zags on the way. You get these reports coming out every month or every week, whatever this one is, monthly, I believe. And once it clearly turns a corner, again, just take a look at these charts. Once the bottom is in and the trend is clearly more than just one of these little blips, or I don't call them aberrations, they're just little squiggles on the way down. You get little ups and little downs. You can see them here. But once you clearly see the turn, especially at the bottom, you don't look for it when you're up here after things have just peaked. You're not going to see it there. You look for it at the bottom. This is where in modern history, right here, these lines I'm drawing, is where unemployment bottoms out. And the thing is, when it bottoms out, it doesn't go sideways for a long time. And I've covered this quite a bit recently. It's a V. It's a V every single time without exception. What follows that V? What follows that trough? Again, without exception, these gray lines here, 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 and here are recessions. So again, guys, maybe it's going to be different this time, but I'm showing you some of the very reliable charts, and the last one I've covered many times too, without any exceptions too. The Fed goes on rate hiking campaigns. Rates should typically knock the stock market down and cause a recession, rising rates, and they do. However, there's a lag time, and it's quite a bit. And so the one thing you want to look for is as soon as they start cutting. I'm just showing you all the reversals, after a peak in the Fed funds rate. I'm going to show you where we reversed, where the pivot came. There was one. You didn't have a recession there. That's the one. But that also came after this wonkiness here. That was the highest interest rates, Fed funds rate over 20%, massive major recessions going on back then, stock market drops. Here's all the turns here after, again, a Fed rate hiking cycle. Turn, turn, turn. That was COVID recession. And here we are. And a lot of times you plateau and then turn. So again, according to this, it would be a first, or one out of 20, whatever you go across. You go back in time here. 1, 2, 3. You can look at all. There's one there, and you didn't get one. So can it happen? Yeah. There's 2 instances I'm going to show you right there. Those are the only 2 that I see. Mid 90s, we had a pretty big rough patch in the markets back then on that time around. But you can see much more often than not, especially after a strong rate hiking cycle like this, the turn comes, and the only reason they're cutting is because the recession, it's already baked in the cake. In other words, this is damage done. I've used that analogy, and it's the whole lag effect. It's like, when somebody gets gunshot wound, and or a hunter shoots an animal and it's not a kill shot, and the animal runs for a while and they bleed out and then they eventually die. People get shot all the time. If you're not shot in the head, you get shot somewhere else internally. The damage has already been inflicted. Sometimes you get to the hospital, you make it to the ER in time, you might feel okay, but they end up losing that because the damage, a major artery was severed, or an organ, and you bleed to death. That's the way I see the lag effect. So these rising rates, and I know the market's been cheering it. Oh my God, it doesn't matter. Rising rates this time around, it doesn't matter. Oh, when you couple this with the amount of consumer debt that I just showed you in this video, and now more importantly, you want the timing to that. Yeah, consumer debt can go up and up, just like with federal debt. Who would ever thought we would have a debt to GDP ratio that we're running now? And that can go up and up. It doesn't matter until it does matter. So the one I showed you where it does matter is the defaults, this one. So if this was still down here and we weren't seeing default rates surging like they did right before the financial crisis, I would say, you know what? Hey, maybe we've got another couple of years. Maybe it won't be till 2026 till we see a recession. Consumer strong. I don't know how they're doing it. Maybe it's paychecks or a lot of cash stashed away, but no, that's not the case. They've stopped paying and they're surging up, and this is going to carry over. The banks can only have that mark to fantasy thing so long. They can only delay recognizing these losses and these write-offs for so long. So anyway, so I think those charts are important, and they're pretty clear too. Okay, now let's talk. I told you I'd talk just briefly about kind of that long term. I know I've been singing the long term recession, big bear market coming song, for a while. That in T7 I'll probably be adding additional targets. T7 if hit. Remember, we have recently hit. This was the market top range. For those of you new to the site, on late June, before we got here, I gave a range based on a combination of multiple factors, including but not limited to Fibonacci extensions, price target extensions to the upside, Fibonacci retracement levels to the downside, which align with my targets and other things. And we came within 1.5% of the top of the range. And it was a relatively tight range. And we also printed bearish engulfing candles on the NASDAQ 100 and the all-important semiconductor sector and some key stocks in. So as of now, this is my kind of longer term outlook, and nothing's changed. We hit T2, we went down there, we were short all the way down. We even gained a little counter trend bounce on the way. It was on the daily charts there, and then we reversed there. We covered all shorts, went long, expecting a nice reversal off the 200-day moving averages and T2, which they bought. And so now my view is it's a counter trend rally that's run its course. We're going to go down. Might have a little reaction around T3, probably some reaction, but I don't think it's going to be anything like this one. So I don't plan to be, called for a double-digit rally there, and use the term likely an explosive rally. That's what we got, to the double digits. This time around, I don't think we're going to get it if and when we get there. Now, I'm getting 3 steps ahead of myself, and this is the important thing. So even though if I think we're going here ultimately, I'm going to, when the risk reward is there, when the charts tell me, I'm going to cover shorts, and it's not going to be a straight from here to here or even those lower targets. It's going to be, as I said, I'm going to try my best to game it and game the counter trend bounces, and and that may entail what I called, this was a hard reversal, meaning cover all shorts immediately and go full long that morning of August 5th. And this was a scale back into shorts, where scale in from here, scale up to here, but no higher, with stops, somewhat above here. And so that's what I call a soft entry or a scale in. And so we'll, and I can only tell you if and when we get to any of these, what that'll be like. Now, okay, so that's where I think things are going. It helps formulate the bigger picture. But the analogy I'm going to use is, look, I don't bet on sports. I've never been I don't, this is my, if any kind of bets I'm going to lay, it's going to be on the stock market, because I have much better confidence in technical analysis in the charts than I do on, on sports betting. But let's just say, okay, I'm born and raised in Miami, so the Dolphins are my team. So let's say I was thinking they were going to win the Super Bowl, and I was confident they were going to win it this year. Not that I am, but so I might tell you, hey, Dolphins are going to take it down this year. They're going to go to the show and take it home and win. But let's say I was a betting person again, which I'm not. But as each game progresses, in other words, if they get, tail end through the season and they're 3-6, I'm not going to be calling for that anymore, right? I'm going to have changed my outlook. There's no way they're not going to make it to the playoffs. They're not going to win the Super Bowl. And if I were to bet on them, it'd be each game, because as the season progresses, the outlook will change based on player injuries, based on how they're playing, momentum, all that other kind of stuff. And it's the same exact way in the stock market. So I might tell you today that I think we're going to be here within a year or so. And if we go, and that this was likely to top, but if we go here, then at that point, I'm going to tell you, hey, do I think we're going to go here, and maybe give you new market top ranges, or do I think it's going to be this, a marginal new high, or do I think we're going to do this? So in other words, my positioning is determined this chart factors in, but day to day and week to week, it's these daily 60-minute charts, and even as of this week right now, like I said, that 15-minute chart. I've got an active trading account. Those 15-minute charts I gave you this morning, this doesn't change my positioning in my longer-term accounts, IRAs, things like that. Not at all. Active trading account, yeah, it's good for a quick pullback trade. There's NQ, it dropped since it took that level out. It was about I'm just trying to measure it here. I'm having a hard time. Looks to be about a 0.75% bounce. It's so hard if you touch the other trend lines, they move. That's why I have to do it this way. That was about 0.77% drop. And now the way it also works, these 15-minute charts, they might be useful to a longer term swing trader as well as an active trader, because if we have a definitive break below or above this range in the S&P, that's likely to determine the next trend. As of now, here's ES. There's that level I showed you earlier. 5610, we've taken it out. Unless they can rally back up and get above there, it means the next stop is going to be, actually we're right on it. We're 5610, never mind. We're right on it. So, but we went below it and we're really back testing it. So if they get rejected now and we start moving away from it, then we're probably going to do this. And that's probably where we'll close today or next week down, or the next stop will be that level, whether it's today, tomorrow, next week. They get back above, well, now this trend line that I gave you this morning before we even broke it, it's validated, because when we broke it, we didn't just limp through, we had an impulsive drop. So now that becomes resistance on a back test, as are those same levels I gave you from before. Okay, so this is near-term stuff, likely to determine the near-term direction, which then you look at things like QQQ. Do we break to the upside? Does this potential bull flag? Remember, there's this potential bull flag continuation pattern. So if ES pops that level and QQQ and NQ takes out those overhead resistance levels, that could still be in play. We're not going to see it. We won't have a definitive move this week, but maybe next week. Likewise, if we go much lower, the flag is already getting long in the tooth. It's not going to have the symmetry will be lost. What I mean by that, relative to the length of the flagpole here. So, I certainly can't write it off. To write it off and dismiss it would be just complete horrible bias. So I'm recognizing it as a potential. But if we break down, the flag then is destroyed. So that takes that away. And you also get a bearish PPO crossover down here on the MACD. PPO, I'm sorry, and you can see what happened the last time we had a bearish PPO crossover was right here. It stayed red right here this whole time. We milked that from top to bottom with impunity, reversed, and went green. And so now we'd be looking for another drop, a crossover here. Again, that's when the PPO crosses over, we go down to red there on the histogram. Okay, NVIDIA green today, but we're up 0.5%. So that's essentially flat for NVIDIA. If NVIDIA is not up or down at least 3%, it's basically flat because it tends to move quite a bit, in percentage terms. So, divergent high back there, trend line break, bearish engulfing candle, which again, just like QQQ put it in afterwards, so did I believe the semi-sector might as well. But right here, I think it was when the Q's topped. But either way, that was the top in NVIDIA. We're only looking at a 60-minute chart. On the daily, that was a bearish engulfing candle. So just like QQQ, until and unless, here, you can see it here on the daily. That's it right here. Until unless that bearish engulfing candle is taken out, I'm viewing that as a likely topping stick, meaning an end to a bull trend, the beginning of a new downtrend. However, those odds are going to go up significantly once we take out the trend line, which was also my first target on the daily chart. Remember, we hit it here. I gave you targets it was actually on the weekly time frame right here. NVIDIA, first target hit here. 200 days, that uptrend line, that's your primary uptrend line, which again, I'll just go back to the daily chart right here. It's a hell of an uptrend line. Comes off the October 2022 lows. A lot of reactions. Most important, a nice, clean, distinct reaction more recently to help validate it further. Remember, I had this trend line long before we even hit it there. And then when we hit it, the fact that we had a double-digit bounce helps to further validate that as an important trend line. So if and when that goes, and that support level just below it right there, or just say the recent lows in the 200-day moving averages, they're all in close proximity. The odds for my much deeper targets on both QQQ as well as NVIDIA go up substantially. That's how it works, guys. Maybe that's all we get, and we'll go down to saying, okay, well, it was a trade, and it was, no matter what, you can't call it a failed trade because, hard cover there. That was NVIDIA too, cover all shorts. So we milked that move down. That can't be erased. Those gains are booked. So was the profit on going long halfway up. And now I'm sure we're short again, or I am. I told you that. We had a breakdown right there. Haven't yet added my shares. I still have some puts, October puts. But I'm going to add shares if we get some further evidence. Basically, those 15-minute charts I showed you, NQ and QQ, ES, I want to see those break down. And that's probably not going to happen until next week. This is also a big level on the video. Remember, this was my first target zone from this short back here. That was the minimum and initial target zone. We danced on it for a while. We broke it. We back tested it. Then we hit my second target zone here. Then we hit the third target there, we covered in reverse. So this is support was back then. The fact that we hit it, danced on it, then broke it and got rejected on the back test further validates that as support. And so we're there. So once that goes, that opens the door to more selling. And because of the psychological importance of NVIDIA, I really doubt we're going to do this and see the NASDAQ 100 or even the S&P 500 going up. So this is a big level to watch, and that's a level where most likely, if it happens next week or anytime in the following weeks, maybe we dance on this for a while. Maybe we never do. But if we do, then I'm going to increase my short position. And Intel, still my only semi, one of my favorite longs, both as an indirect hedge or a pure play. Again, this is based off we're on the weekly. It's based off this long-term pullback to support right here on the weekly chart. Great support, positive divergence on the weekly time frame, and I'm going to zoom down because we have an important level right here. You can see we've got this little basing pattern right here. We've had 1, 2, and now today 3 attempts at the level. I'm gonna move that line and just put a price level there. Tell you what it is. I mean, you can just look at it and see it's the recent high. So it's about $22. So if Intel can pop 22, it should run. And as I told you in recent videos, this is my first and minimum target. So you'd want to sell a little bit below. It's about 24.66. A lot of eyes are going to be on that level when we get there. If we get some traction and the semis hold up all together, I'll be closing out semi shorts and I'll be just pure long Intel. Again, I'm viewing it as a kind of an indirect hedge. It's a semi, obviously, but it tends to have its own, almost trades inversely to the rest of the sector for the last couple of years. And this is also a poster child of what stock buybacks will do. I had a chart up. I don't have it queued up now. You can Google it. It had the history of Intel buybacks, and they were issuing a bunch of big buybacks here, buying their stock back, and you see where that got them. So I think at some point in the future we'll see that same thing with Apple and Nvidia and all that. And if they're buying at these levels, again, look at the Shiller P ratio. I think it's criminal, honestly. I mean, not literally, but it's poor financial management to be buying your stock back at these levels. But and it also goes and shows they're running out of innovation. They're just plowing money into stock buybacks and AI. And I've said it before. You guys, I welcome open the comments. I get pushes from Google every day. Please try our Gemini AI free. It's coming free on the new Google 9 phone, Pixel 9s. They just shipped out. You get a year free of the premium one. They're so nobody's buying it. I look at what it can do, and it's I don't need that. Maybe others are, and we'll see. Apple's going to integrate it into their phone. The new phone's coming out. But anyway, my point being, as I've been saying, they will eventually see when they're not getting the return on the massive investment they're plowing in. All they got to do is pare back a little. You have that, of course, I'm talking NVIDIA now, and then coupled with the fact that, this whole let's not sell our NVIDIA chips to China. Guys, you know this. China, if they have one skill set, other than, and I don't want to sound offensive, other than creating fireworks, as they're probably their one big claim to fame back thousands of years ago, what they're best at is reverse engineering things. You don't think with the U.S. saying, no, you can't buy the latest generation Blackwell chips from NVIDIA, you don't think China's going to eventually come out and just reverse engineer the technology or come out with something better? So that's going to ultimately backfire. AMD is already making leaps and bounds, they say, towards AI chips. So this whole, NVIDIA's a poster child. Just watch NVIDIA. The rest will follow. We already saw what SMCI has been doing. They were the, kind of little NVIDIA junior. You can see where they're going. They're still coming down to those targets. And so that's kind of the update there. And then the semiconductor sector. I'm going to rifle through this because there's a couple that I saw that stood out today. So on SOXX, just the lights out level for the SOXX semiconductor ETF and that tracks the SOXX, Phillips SOXX semiconductor sector is a break of the trend line. I want to see this yellow trend line go. When it does, it should be lights out for the semiconductor sector. Then I look at long-term targets, which I've already given you, I believe. Long-term targets down here. So I'm calling for, from the highs, a drop of at least 45% in the semiconductor sector. And I know most don't. They think that's ludicrous and crazy. And I've done this 101 times in the past, showed you the history. It's just the nature of the sector, and you just have to understand if you traded long enough. That's one benefit I have with having some gray hairs now. I've been doing this long enough that I've traded and invested through these cycles. This is just boom or bust in the semis. When it's boom, it's great. It's hot, and the rallies are well into the triple digits. But when they correct, 55%, 85, 70, 28. 38, 40. And these are all just 28, 27, 38. These are all, by the way, measured off the divergent highs. Those are what I measured for you there. That was a dot-com bust right there. These were divergent high corrections. Remember, all of these since the low right here and the bear market from the '08 bear market, 2007 to early '09, they were all just simply corrections in an ongoing bull market. Even that 48% drop, all it did is take us back to the uptrend line. So for me, calling for a drop of just to the trend lines about 50%, guys, that to me is that's my bullish outlook. That's my bullish outlook. If we only drop 50% and bounce, all trend lines sooner or later are broken. And so based on these big divergences, we could crack the trend line and go even lower. But again, the 40, roughly 50% drop I'm calling for would just be a reversion to the mean, coming back in to test the secular bull market uptrend line. So, and again, it's in line with other previous corrections. But these are your secular bear markets. When things get really ugly, you're going to see drops more than 25 and maybe even 50%. So, and again, one step at a time. We're not going to get there down to these deeper. Where are my weekly targets? Oh yeah, that's SOXX. That's the actual Phillips semiconductor sector we're looking at here. This is the ETF that tracks it, and so those are my targets right here. We're not going to get down to these deeper targets unless, and remember, there's that. I really should put that trend line there. That's the longer term uptrend line, which comes in with T6. We're not going to get there until we take this level out. When we take this out, the odds are going to go up. If I had to give you odds, I don't like this game. Let's just say right now I'd put it at 60% that we're going to go down to those long-term targets I have. T6 on the weekly chart I just showed you, that 45% drop. But when we take this level out, they're probably going to jump up to about, in my opinion, 80%. That's how it works in my head. So then at that point, if the market checks out, you like what I see there on the NASDAQ 100, big tech, the S&P 500, the financials, everything else to support a case for a much bigger drop in the semis. What I do is I increase my, my confidence goes up, so does my position size, and it goes up strategically, or tactically. Maybe it breaks down, it's a huge waterfall sell-off, then I wait for a kickback rally to short a back test. Ditto for NVIDIA. When that level goes, that same trend line lights out for NVIDIA, especially down below the 200 days and that 96 level there. I'm going to rifle through there because there were a couple of these that look like objective short entries if you're interested, if anyone's interested in shorting any. Taiwan Semi has bounced back to this gap right here, which so far has capped it. It's similar to, remember on SMCI a couple weeks ago, I showed you it testing the bottom of a gap, and SMCI got rejected hard off there. Taiwan Semi, who makes the chips for NVIDIA, they're the manufacturer. So they're obviously their fate's intertwined with NVIDIA, and they hammered off the 200-day moving average recently. So I just want to point that out. Resistance there. The top of the gap is also resistance, so you'd probably want to stop a little bit above that, because if they pop the top of the gap, they're probably going to put in a new high. Any new high soon will be a marginal new high. So if you're playing the long game, you can give yourself, your stop should be relative commensurate to where your price targets. If you have price targets down here, you can give yourself a 15% stop if you're looking for a 50% drop. If you're only looking for a drop down to the 200s again, then you want a tighter stop, and that's where you'd be right above the top of that gap. Broadcom, purple trend line needs to go, lights out, as well as the 200-day moving averages just below it. ASML already put in a lot of these stocks. A lot of the semis already peaked. They put in divergent highs. They're well below. I just want to show you a few. AMD, this yellow uptrend line, we had a brief pop below, but remember, everything else was hitting 200-day moving averages, including the indexes. And so it was a brief whipsaw down below, and we're back on it now. But another breakdown below it will be bearish. Qualcomm, well off the divergent high plus island top. See that little island top? That's a candle separated by gaps on both sides. And it's at resistance right now, too. So this is kind of your overview for the semis I wanted to give you. So you could, now it's pinched. It's got the 200 days just below it. So it's in this trading range. And just like the S&P 500 or ES that I showed you, bulls win, bears win, at least the near-term battle. Texas Instruments, big divergent high, nice clean uptrend line in which you want a solid red candle, solid close below there. Especially a weekly close, and that one is looks like a end of the run or close to it, in my opinion. AMAT, chip equipment makers. So as I always say, if these semis are the canary in the coal mine for the tech sector, which they are, in my opinion, The chip equipment makers, those that make the equipment that make the chips, are the canary in the coal mine for the semiconductor sector. Because when they start seeing orders drying up, that tells you that there's a turn in the sector. And so we've seen that, KLAC and AMAT being two of the bigger ones. Perfect breakdown of the primary uptrend line right there, back test. And we're right on the 200s right now. So it already undercut them, recovered them, and we're right back to them. So if it goes much lower, you can maybe short it under break of the recent lows, because that means that this second test here of the 200s failed. And it's already rejected off the back test. So, and you'd want to stop if it regains that trend line, stop out there. Otherwise, just kind of these are kind of tuck it away trades, in my opinion. We're either going to get stopped out and power on to new highs. There's a big old gap there. I just wanted to point out that one's in a bearish technical posture. ADI, analog devices, another one peaked on a divergent high right there. A KLAC, another big chip equipment maker, just like SMCI and some of the others I showed you, has this big, very technically significant gap that it's been stalling up against. The gap happened here, right there. We tried to test the bottom of it, got rejected. Test the bottom, it's been rejected so far. So that's resistance. If it enters a gap, it'll probably want to make a backfill of the gap. Anything other than that, it's probably going to go to new highs. Looking at a potential bearish PPO crossover. The last time we had a bearish PPO crossover was right there. And you can see what happened. Again, it hasn't happened yet, but a lot of these, you can see a lot of the semis. So we're at a pretty important crossroads here. I think if the next week or two, the semis clearly move lower, you're going to get more of these bearish crossovers, more of the rejections off those resistance levels that I've showed you, like the gaps. Otherwise, if we go up substantial over the next couple weeks, well, these are going to bounce. You're not going to get the bearish crossovers, and you're going to take out some resistance levels. Lam Research, another big semi equipment maker, beautiful bearish rising wedge following a divergent high breakdown. Hit my target right here, 723.79. You can see I created that level back on April 8th, 2024. So it's not just a random level I added after. That's where I figured once this level went, this was price support there. Big support, 200-day moving averages also in one fell swoop. Price support in the 200s were taken out. The stock plunged, reversed exactly where I had the first support level. Bounced. Where did it bounce to? Right back to resistance. This is a resistance zone, really. It was a support zone, and the 200-day moving averages. You can see this stock, like so many tech stocks, behaves very well to the 200s. In a bull trend, you want to buy pullbacks to it. In a bear trend, you want to short rallies back to it, like you did here. And so this is a breakdown, a back test, and a rejection. So that puts that stock in a bearish technical posture until and unless it recovers the 200s as well as this 905.52 level. And so that tells me this is just a kickback rally with more downside. Micron, same thing. Divergent high, bearish engulfing candle, trend line break. If that's not enough sell signals for you, the stock fell from that bearish engulfing candle, dropped 46%. So that just shows you what can happen. And that's in a kind of in a bull market in semis, right? And that's a 46% correction. What did it do? It took out the 200s here. It rallied back to them, tried to get above them for a couple days, couldn't, back below them. So that is a failed back test of the 200s. Where's the lights out level for Micron? Right here. Trendline support. I'll color it up yellow for you, or purple, make it big and fat. There's your uptrend line, nice and clean, numerous 1, 2, 3, 4, now 5 distinct reactions. And below that level, lights out. And again, I take this, when I say lights out, guys, I take it collectively. If just Micron breaks that level, is it going down another 50%? No. If it breaks that level, well, maybe. If it breaks that level and half of the or more of the other stocks that I've just covered here as I'm going through the components that SOXX do, NVIDIA especially, SOXS, XOXX, yeah, they all break those comparable uptrend lines. Yeah, Micron's going a lot lower. As much as it's already fallen 40 something, almost 50% off the highs, it's going a lot lower. When I look at the weekly chart, here's my weekly on Micron. Here's your secular bull market uptrend line, comes off the late '08 lows. Lots of clean reactions, been dancing on it here. So you can see here, this is that first uptrend line I showed you on the daily a minute ago. When that goes, it brings you back to your bull market uptrend line. So that tells me that if that first trend line goes, the one I showed you a minute ago on the daily, and you see right here, it's going to drop about another 20%, and then they're going to step in and buy it here at the secular bull market uptrend line. Intel, I've already covered quite a bit, and I'm just going through a few others because there were some that stood out. Resistance on NXPI right there, 263, after that big bearish rising wedge, divergent high breakdown. Marvel, one of the better looking ones. I wouldn't be shorting this one. It just took out that downtrend line right here. Now, I wouldn't buy it either because of my outlook on the semiconductor sector. The only one I'm buying right now is Intel for the reasons I stated. But it's got a divergent high, so I don't think it's going to go up much more. But again, I wouldn't. It looks better than the rest with that breakout. MPWR, divergent high, trend line right here. It needs to break that trend line, then that 781 level. MCHP. Okay, I had to pause it there for a phone call. I need to wrap this video up. We're going to getting close to the 1 hour mark. Guys, remember you can always hit the fast forward. I always do watching videos. Go to settings, increase playback speed to 1.25, 1.5, even 1.75 is usually where I run it. And I'm going to give you a couple more here. MCHP, nice resistance there at 83.25 plus an uptrend line, which short, you're below the 200 days. Although this one sliced through there. When I see a stock slicing through key moving averages like they're not even there, I don't put as much weighting on them. I just want to say that. I like to see stocks that respect a certain moving average before I put much of a weighting on it. ON, downtrend line, I wouldn't. This one looks like it might want to pop that and run. But then again, it's resistance. I don't have a strong opinion there. Let's just move on. STM broke that level. It's just, this is what's happening. A lot of these semis are, you're either NVIDIA or up there, or you're, not. It's like the stock market. When you go down to the lower tier stocks, a lot of them are still in bear markets. These are semis here. UMC, I don't have an opinion on that one. TER, big divergent high, knockdown, and this one is, you have a big old gap right here and price resistance. We're at the 138.27 price resistance now. Could give you an objective short there, and with also an objective short at the top of the gap here at about 143 or so, with a stop somewhat above, targeting somewhere down here. I haven't updated this chart in a while. I'm going to pull that line down. That would be my target, 95 sold target. That gives you profit potential about 31%, so therefore that stop loss would only be about 6%. Very nice RR in my opinion. Whether it plays out or not, like you just take these trades mechanically, use a good risk reward ratio, and obviously take the trades you think are going to play out. And ENTG, look at this, beautiful. There's an uptrend line just like all the others. Breakdown, back test, objective short entry here. You're also below the 200-day moving averages and 123 price resistance. So my stop would be right there. Short here, targeting, just kind of go with the flow now. Again, if I'm looking for another 45-50% downside in the sector, I think it's easy to say this one's going to drop at least 20+%. All right, I'm going to wrap it here. These are in the bottom tier of the SOXX. I haven't updated this one in a while. I'll just tell you there's your uptrend line breakdown. I can tell you it's this one also behaves very well to the 200-day moving averages. It was below them, rejected, took them back right here. And then once you're above it, the trends change to bullish. You buy pullbacks to the 200, you buy pullbacks to the 200, pullbacks, and then you sell breaks to the 200 or short rallies back into the 200s, which this one is. So that is an objective short entry with a stop somewhat above, because they'll tend to move through there a day or two, somewhat as relative to your price targets and your on that one. And I would say you get an uptrend line right here. And just bump me, guys. I'm going to stop the video here. If you want targets on any of these, I'll sharpen my pencil and give you targets. But it's the same story on a lot of these semis, like I said, are looking quite bearish. And so when you kill the 5-star general, NVIDIA, that's it. The sector is dead. And a lot of profit potential on there. All right, again, this is it. That's the last of the holdings of SOXX. You can see what's happening to the bottom tier semis. And just imagine what's going to happen when the leaders crumble or break. All right, I'm going to wrap it here. I'll do wheat still looks good. Nat gas is still holding around those lows, so still has a potential to run. Still has divergences, looking good there. And anything else that I forgot to update, I'll try to do in a separate video or static post for you later today. This has been Randy Finney with Right Side of the Chart. Have a great weekend.